So you've probably seen the headlines about inflation, right? Maybe you even felt a little bit of relief. But what if I told you that the number everyone's been talking about is already telling an old story? What if the real threat to your wallet is a storm that was gathering just over the horizon, completely missed by the official data? Okay, let's dive into this.
Here it is. This is the number that got everyone talking. 2.4%. That was the official year-over-year inflation rate for February. And, on the surface, that looks great. It's stable, it's predictable, it was pretty much exactly what the market was expecting. It really felt like we were finally on the right path.
But here's the twist in the story. What if this seemingly calm number is actually the calm before the storm? What if the single most important economic event of the last month happened after this number was even calculated? Well, that's the piece of the puzzle we're about to put together right now.
So, to really understand what's coming, we first have to look at the official story. Let's peel back the layers just a little bit on why those February numbers looked so deceptively stable. The numbers really told a story of balance. The overall CPI, that was up 2.4% for the year. And even the core CPI, that's the one that strips out the volatile food and energy prices, it was right there at 2.5%. The monthly increase was tiny, just 0.3%, and that was mostly because core services costs actually went down. So, on paper, everything looked perfectly under control.
And this, right here, is where our story takes a very sharp turn. Because while all the economists were looking at these calm February numbers, something else was brewing, something that threatens to blow this entire picture right out of the water.
Here's the problem. See, right at the tail end of February and heading into early March, after the data for the inflation report was collected, oil and gasoline prices just surged. They shot up. And the crucial point here is that the February inflation report completely, totally missed this. The data collection was already over. And the scale of this surge is, well, it's pretty staggering. We're talking about 20%. In just 2 weeks, the price you pay at the pump jumped by a fifth. Now, this isn't some slow burn. This is a genuine price shock, and it's completely invisible in that February data. Okay, so what does a 20% jump at the pump actually mean for the next inflation report? Well, we don't have to guess. There's actually a pretty reliable way to forecast the impact of something like this. All right, let's break this down. Analysts have this handy rule of thumb. For every 10% increase in gasoline prices, the energy part of the inflation index usually goes up by about 4%. Simple enough, right? Well, since we saw a 20% surge, you just double that. That means the energy component of the March CPI could jump by a massive 8%. And that, in turn, is projected to push the entire monthly inflation rate up by half a percentage point. That is a huge jolt to the system, all from a single factor. Now, you can imagine this sudden spike in inflation puts the Federal Reserve in an incredibly tough spot. They were just getting ready to maybe start cutting interest rates, but now they're staring down the barrel of a whole new inflation threat. So what do they do next? And this brings us to the word that keeps policymakers up at night: stagflation. It is truly the worst of both worlds. You've got prices going up, which obviously hurts your wallet, but at the same time, the economy is slowing down, which hurts jobs and growth. This is the exact scenario the Fed is absolutely desperate to avoid. So the Fed is essentially facing two possible futures here. On the one hand, if this oil shock is just a temporary blip and prices come back down, the Fed can probably just ignore it and stick with its plan to cut interest rates. But on the other hand, if these prices stay high, that starts to really damage the economy and brings that risk of stagflation way up. But what's really fascinating is that even in that bad scenario, the Fed might still cut rates. They might decide to prioritize saving the economy over fighting this new wave of inflation. It's a true dilemma. So where does all of this leave us? Let's try and distill this down to the key things you need to remember. Here's the most crucial point. Forget those February numbers. They're old news. They're ancient history. The real story to watch now is that 20% jump in gas prices that happened after. This all means that the March inflation report could be a real shocker, and it leaves the Federal Reserve walking an incredibly fine tightrope between controlling prices and keeping the entire economy growing. And that leaves us with the ultimate question. As the policymakers weigh their next move, what are they going to choose to protect first? Will it be the value of the money in your wallet from rising prices, or the strength of the overall economy? The answer to that is going to affect every single one of us.